Over the past 20 years, 94.1% of actively managed domestic equity funds underperformed their benchmark index. That's not a typo. According to S&P Dow Jones Indices SPIVA Scorecard, the most comprehensive study of active fund manager performance ever published, fewer than 6 out of every 100 professional fund managers beat the market over 2 decades. These are people with finance degrees, Bloomberg terminals, teams of analysts, and access to research that costs 6 figures a year, and 94 out of 100 of them lost to an index that charges essentially nothing and requires zero thought. If the professionals can't beat the index, you can't either. And that's not an insult. That's the best news you've heard all year, because it means the optimal investment strategy for most people is also the simplest, the cheapest, and the most boring one available. Buy the whole market. Automate it. Forget about it. Check once a year. That's the strategy that beats 94% of professionals. This video is a complete step-by-step setup guide for someone with $500 a month and zero investing experience. By the end, you'll have a portfolio that runs on autopilot, costs almost nothing in fees, requires about 15 minutes of attention per year, and has a higher expected return than what most financial advisors deliver. Not because you're smarter than they are, because you're boring enough to not try. Before we set anything up, you need to understand one concept: why the index wins, not philosophically, mechanically. An index fund, like a total U.S. stock market fund or an S&P 500 fund, owns every stock in the market or every stock in the 500 largest companies. It doesn't pick winners. It owns everything. When Apple goes up, you benefit. When some company you've never heard of goes bankrupt, you barely notice because it was 0.02% of your portfolio. An active fund manager, by contrast, picks stocks. They buy 40 to 80 companies they believe will outperform. To outperform the index, they need to be right more often than they're wrong, after fees. And the fees are the killer. The average actively managed fund charges an expense ratio of about 0.65 to 1.0% per year. A total market index fund charges 0.03 to 0.10%. That difference seems small? It isn't. On a $300,000 portfolio over 20 years, the difference between a 0.05% fee and a 0.75% fee is roughly $120,000. That's not a typo either. The fee difference alone, compounded over 2 decades, consumes 6 figures. The active manager doesn't just need to beat the index, they need to beat the index by enough to overcome their own fee drag, and 94% of them can't do it. So the boring portfolio doesn't win because indexing is a brilliant strategy. It wins because everything else is a worse strategy that costs more. Boring wins by default. And in investing, winning by default is still winning. Here's the setup. Step by step. No jargon. No assumptions. If you've never invested $1 in your life, start here. Step 1, open a brokerage account. This takes about 10 minutes. You need an account at a brokerage firm that offers low-cost index funds. The 3 firms that serve this role for the vast majority of individual investors are Fidelity, Vanguard, and Charles Schwab. All 3 are reputable. All 3 offer the funds you need. All 3 have 0 or near 0 account minimums. Pick one. It doesn't matter which one. This is the first decision that people overthink, and it costs them months of compounding. Fidelity, Schwab, or Vanguard. Go to their website. Open an individual brokerage account. You'll need your social security number, a bank account for linking, and about 10 minutes. Done. If your employer offers a 401k with a match, do that first. Contribute at least enough to get the full match before opening a separate brokerage account. The match is an instant 50 to 100% return. No investment in history beats free money from your employer. Step 2, pick 1 or 2 funds. This is where most beginners spiral. There are thousands of funds. Which one is the best? None of them. They're all close enough that the differences between them don't matter as much as actually buying one and starting. Here's what the boring portfolio looks like. Option A, 1 fund, maximum simplicity, a total U.S. stock market index fund. This owns approximately 3,500 to 4,000 U.S. stocks across all company sizes. 1 fund, entire market. The Fidelity version is FSKAX. The Vanguard version is VTSAX or VTI as an ETF. The Schwab version is SWTSX. Expense ratio, 0.015 to 0.03%. That's 3 to 15 cents per year for every $1,000 invested. Coffee costs more than your portfolio management. Option B, 2 funds, slight diversification, 80% total U.S. stock market, 20% total international stock market. The international fund at Fidelity is FTIHX. At Vanguard, it's VTIAX or VXUS as an ETF. At Schwab, it's SWIX NYSX. This adds exposure to companies outside the US. Some investors prefer it for diversification. Some don't bother. Both approaches are reasonable. Pick one and stop deliberating. That's the portfolio. One fund or two funds. Total cost, under $3 per year for every $10,000 invested. No advisor fee, no trading commission, no front load charge, no 12B1 fee. Just the fund's expense ratio, which at these levels is essentially rounding error. Step 3. Set up an automatic monthly investment. This is the most important step. Log into your brokerage account, set up a recurring transfer of $500 from your checking account on the day after your typical payday. Then set up an automatic investment of that $500 into your chosen fund. Most major brokerages allow you to automate both the transfer and the purchase. Once this is set up, you are done. Money moves from checking to brokerage on autopilot. Money buys shares of the index on autopilot. You don't choose when. You don't choose the price. You don't wait for a good time to buy. You buy every month at whatever the price happens to be, regardless of whether the market is up or down. This is called dollar cost averaging, and it eliminates the single largest risk in investing, your own emotions. When the market is high, your $500 buys fewer shares. When the market drops, your $500 buys more shares. Over time, this averages out to a cost basis that captures the market's long-term upward trend without requiring you to predict anything. The people who lose money investing are almost always the people who tried to time it. The boring portfolio removes timing from the equation entirely. Step 4, do nothing for a long time. This is simultaneously the easiest and hardest step because the market will drop. It drops regularly. On average, the S&P 500 experiences a 10% correction about once a year and a 20% decline about every 3 to 4 years. When it happens, your portfolio will show red. Your $50,000 will temporarily become $42,000. Your $200,000 will temporarily become $164,000. The temptation to sell will be enormous. Do not sell. The 94% of professional managers who underperformed the index, a large portion of their underperformance comes from selling at the wrong time and buying at the wrong time. If professionals can't time the market, you definitely can't. The historical average annual return of the S&P 500 is approximately 10% per year over the long term. That average includes every crash, every correction, every bear market, and every recession. The return includes 2008, it includes 2020, it includes every terrifying headline you can remember, and it's still 10%. That return is available to anyone who buys and holds. It is not available to people who buy, panic, sell, wait, buy again, panic again. Every sell and rebuy cycle costs you in taxes, in timing error, and in the missed recovery that almost always follows a crash. The boring portfolio works because you don't touch it. The moment you start touching it, it becomes an active strategy with all the risks of active management and none of the resources. Step 5, rebalance once a year. If you chose the two-fund option, your 80-20 split will drift over time as one asset class outperforms the other. Once a year, your birthday is a good date. Log in and check. If the allocation has drifted more than 5 percentage points from your target, say it's now 87-13 instead of 80-20, sell enough of the overweight fund and buy enough of the underweight fund to get back to 80-20. This takes about 10 minutes. If you chose the one fund option, you don't even need to do this. Your annual maintenance is log in, confirm automatic investments are running, log out. Total annual time, 5 minutes. That's the entire portfolio. 1 or 2 funds. Automated, boring, and here's what it produces. $500 per month at 10%, the historical average over 20 years, $382,000. Over 25 years, $662,000. Over 30 years, $1,130,000. At a more conservative 7%, 20 years, $260,000. 25 years, $405,000. 30 years, $608,000. No stock picks, no crypto, no individual company analysis, no options trading, no checking CNBC, no hot tip from your coworker. Just $500 a month into the most boring investment vehicle ever created for as long as you can maintain the discipline of doing absolutely nothing interesting with your money. Now, let me address the objections, because there are always objections. But what about a financial advisor? Financial advisors who charge a 1% annual fee on a $300,000 portfolio cost you $3,000 per year. Over 20 years, that fee, compounded, exceeds $120,000. If the advisor is putting you in index funds anyway, anyway, which many do, you are paying $120,000 for them to do what this video just taught you to do for free. If they're picking active funds, you're paying $120,000 for a strategy that underperforms the index 94% of the time. Some advisors provide genuine value through tax planning, estate planning, and behavioral coaching. That's worth paying for. Portfolio management is not. But I want higher returns. Everyone wants higher returns. The question is whether reaching for higher returns actually produces higher returns. The data says it does not. The SPIVA scorecard, updated every 6 months, spanning 2 decades of data, shows that the more actively you manage, the worse your outcomes. The boring portfolio doesn't promise 30% years. It promises participation in the long-term growth of the entire economy at minimal cost with minimal effort. And that participation, sustained for 25 to 30 years, produces wealth that the vast majority of active investors never achieve. But the market could crash. It will crash. The question is when, not if. And the answer to when is it doesn't matter if your time horizon is 20 years or more. Every single crash in U.S. stock market history has been followed by a recovery that exceeded the previous high. Every single one. The crash is temporary. The growth is permanent. The only way the crash hurts you is if you sell during it. Let me close with 2 people. Same salary, same $500 per month, same starting point. Person A spends 10 hours a week researching stocks. They watch CNBC. They follow Twitter accounts that predict market movements. They trade 20 to 30 times a year. They feel sophisticated. They believe they have an edge. After 20 years, their portfolio has earned 5.2% annually, which, by the way, is roughly what the average individual investor earns, according to Dalbar's annual study. Total after 20 years, $206,000. Person B spent 15 minutes setting up an automatic investment into a total market index fund. They have never logged into their brokerage account on a weekday. They don't know what the S&P 500 did today. They couldn't name a single stock in their portfolio. After 20 years, their portfolio earned 10% annually, the market's historical average, which is available to anyone boring enough to accept it. Total after 20 years, $382,000. Person A invested 10,000 hours of their life and ended up with $176,000 less than person B, who invested 15 minutes. That's the keep it boring portfolio. Not because boring is a compromise, because boring is the optimal strategy. The data says so. The math says so. 20 years of SPIVA scorecards say so. The only thing working against boring is the human brain's conviction that effort should equal results. In almost every area of life, it does. In investing, it doesn't. The effort goes into the setup. The results come from the waiting. Set it up, automate it, walk away, and let the most boring $500 a month you'll ever spend quietly build the future that the exciting strategies never deliver. I'm not a financial advisor, lawyer, therapist, or any other licensed professional. The content on this channel is for educational and entertainment purposes only. Everything shared here reflects my personal opinions and should not be taken as financial, investment, legal, medical, or relationship advice. Any stories, examples, or characters used are composite illustrations meant to explain ideas, not to represent real people or specific situations. Real-life outcomes vary widely because everyone's circumstances are different, and any statistics referenced may come from studies with limitations and may not apply to every individual. Always do your own research and consider your full situation before making important decisions. When needed, consult a qualified professional who understands your personal circumstances.